You pay 30% of your income in taxes, while billionaires pay 15%. You think they must have expensive accountants doing illegal stuff. Wrong. Rich people use the same tax code as you. They just know which parts of it to use. Here's the uncomfortable truth. The tax system is designed to reward certain behaviors and punish others. Rich people structure their lives around the rewards. Poor people accidentally structure their lives around the punishments. Let me show you every legal tax strategy wealthy people use that you can start using today. The business expense loophole. Rich people turn personal expenses into business expenses. Your vacation becomes a business trip. Your car becomes a business vehicle. Your home office becomes a business deduction. Everything becomes tax deductible when you own a business. Meet Sarah. Sarah works a regular job and pays taxes on her full salary. Sarah's friend Mike owns a consulting business. Mike writes off his car, his phone, his internet, his home office, his business meals, and his travel expenses. Sarah and Mike make the same income, but Mike pays thousands less in taxes because he has business deductions. Mike didn't do anything illegal. Mike just structured his income differently. The IRS allows business owners to deduct ordinary and necessary business expenses. The key words are ordinary and necessary. If you can justify an expense as helping your business, it's usually deductible. Start a legitimate side business, even if it's small. Freelance writing, consulting, selling products online, anything that generates business income. Once you have a business, many personal expenses become business deductions. The real estate depreciation trick. Real estate investors get to pretend their properties lose value every year, even when they're actually gaining value. This creates paper losses that offset real income, reducing their tax bill to almost nothing. Meet David. David owns rental properties worth $2 million. The IRS lets David depreciate these properties over 27.5 years. That's about $73,000 in annual depreciation. David's rental properties generate $50,000 in profit, but he shows a $23,000 loss on paper because of depreciation. David pays 0 taxes on his rental income and uses the extra loss to offset his other income. Here's the beautiful part. When David sells the properties for more than he paid, he keeps the real profit. David got years of tax-free income plus appreciation gains. Depreciation is like getting an interest-free loan from the government. You can use this strategy with any rental property. Buy a duplex, live in one unit, rent the other. You get depreciation deductions while building equity and generating rental income. The retirement account, maximization. Rich people max out every retirement account available. 401k, IRA, HSA. They use these accounts to shelter hundreds of thousands from taxes annually. Meet Jennifer. Jennifer owns a business and sets up an IRA. Jennifer can contribute up to 25% of her business income, up to $66,000 annually. That's $66,000 that avoids taxes completely. Jennifer also maxes out her solo 401k, contributing another $66,000. Jennifer shelters $132,000 from taxes in 1 year. At a 30% tax rate, Jennifer saves almost $40,000 annually. Most people only use their employer's 401k and contribute the minimum for the match. Rich people use every available retirement account and max them all out. The contribution limits are the same for everyone, but rich people actually use them. The charitable deduction strategy. Rich people donate appreciated assets instead of cash. They get the same tax deduction, but avoid paying capital gains taxes on the appreciation. Meet Robert. Robert owns stock worth $100,000 that he bought for $20,000. If Robert sells the stock, he pays capital gains tax on the $80,000 profit. Instead, Robert donates the stock to charity. Robert gets a $100,000 tax deduction and avoids paying capital gains tax on the $80,000 profit. Robert saved about $35,000 in taxes by donating stock instead of cash. You can use this strategy with any appreciated asset: stock, real estate, artwork, anything that's worth more than you paid for it. Donate the asset instead of selling it and donating cash. The family employment loophole. Business owners can hire their children and shift income to lower tax brackets. Kids pay little or no tax on their first $12,000 of income. Meet Lisa. Lisa owns a marketing business and hires her 16-year-old daughter to help with social media. Lisa pays her daughter $12,000 annually for legitimate work. Lisa deducts the $12,000 as a business expense, reducing her taxable income. Her daughter pays zero taxes because she's under the standard deduction limit. Lisa shifted $12,000 from her 30% tax bracket to her daughter's 0% bracket. This works with any family member in a lower tax bracket. Hire your kids, your spouse, your parents, pay them fair wages for legitimate work, and shift income to lower tax brackets. The Health Savings Account Hack. The HSA is the ultimate tax shelter. Contributions are tax deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. It's the only account with triple tax benefits. Meet Carlos. Carlos maxes out his HSA contribution of $4,000 annually. Carlos invests this money in index funds and lets it grow for 30 years. Carlos uses the HSA like a retirement account. After age 65, Carlos can withdraw money for any purpose and only pay regular income tax, just like a traditional IRA. But if Carlos uses the money for medical expenses, it's completely tax-free. Carlos essentially gets a tax-free retirement account disguised as a health account. Most people use HSAs for current medical expenses. Smart people use them as tax-free investment accounts. The geographic arbitrage play. Rich people move to states with no income tax. Florida, Texas, Nevada, Washington, and others don't tax personal income. Moving states can save tens of thousands annually. Meet Patricia. Patricia lives in California and pays 13.3% state income tax on her $200,000 income. That's $26,600 annually just in state taxes. Patricia moves to Florida and pays zero state income tax. Patricia saves $26,600 annually by changing her address. Over 10 years, that's $266,000 in tax savings. You don't need to be rich to use geographic arbitrage. Remote work makes this strategy available to anyone. Move to a tax-friendly state and keep your high-paying job. The timing income strategy. Rich people control when they receive income and when they pay expenses. They accelerate deductions into high-income years and defer income to low-income years. Meet Alex. Alex has a big income year and expects lower income next year. Alex accelerates business expenses into this year and defers income to next year when he'll be in a lower tax bracket. Alex buys equipment, pays for services, and makes charitable donations before December 31st. Alex delays invoicing clients until January, so the income hits next year's lower tax bracket. This strategy requires planning and flexibility, but it can save thousands in taxes by smoothing income across multiple years. The investment structure. Optimization. Rich people structure investments to minimize taxes. They hold growth stocks in taxable accounts and income-producing assets in tax-advantaged accounts. Meet Michelle. Michelle puts dividend-paying stocks in her IRA where the dividends aren't taxed. Michelle holds growth stocks in her taxable account where she can harvest tax losses and benefit from lower capital gains rates. Michelle also uses tax loss harvesting to offset gains with losses. When stocks go down, Michelle sells them to realize losses that offset her gains from other investments. Most people randomly put investments in whatever account is convenient. Rich people strategically place investments based on their tax characteristics. The business structure. Advantage. Rich people choose business structures that minimize taxes. LLC, S-Corp, and partnerships offer different tax advantages depending on your situation. Meet Kevin. Kevin starts as a sole proprietor and pays self-employment tax on his entire business income. Kevin switches to an S-Corp election and pays himself a reasonable salary. Kevin's business profit above his salary is distributed as dividends, which aren't subject to self-employment tax. Kevin saves about 15% on the profit portion of his income. The right business structure can save thousands annually in self-employment taxes alone. Most people never consider optimizing their business structure for tax efficiency. The education expense strategy. Rich people use education expenses to reduce taxes while improving their earning potential. Business education is fully deductible, and personal education has various tax benefits. Meet Rachel. Rachel takes courses to improve her business skills. Rachel deducts the full cost as business education expenses. Rachel also uses a 529 plan to save for her children's education with tax-free growth. Rachel gets immediate tax deductions for business education and long-term tax-free growth for family education expenses. Education becomes a tax-advantaged investment in human capital. The truth about tax loopholes. Here's what rich people understand that most people don't. These aren't loopholes, they're incentives. The government wants people to start businesses, invest in real estate, save for retirement, and donate to charity. The tax code rewards behaviors that benefit the economy. Business ownership creates jobs. Real estate investment provides housing. Retirement savings reduce government burden. Charitable giving helps society. Rich people align their behavior with these incentives and get rewarded with lower taxes. Poor people ignore these incentives and pay higher taxes. It's not about fairness, it's about understanding the system. Most people try to minimize their income to reduce taxes. Rich people try to maximize their deductions to reduce taxes. There's a huge difference between these approaches. Minimizing income limits your wealth-building potential. Maximizing deductions lets you keep more of what you earn while building wealth faster. Focus on earning more and deducting more, not earning less. Start with the easiest strategies first. Max out your retirement accounts. Start a side business. Use an HSA if available. Then move to more complex strategies like real estate investing, business structure optimization, and geographic arbitrage. Most importantly, keep detailed records and work with a qualified tax professional. These strategies are legal, but require proper documentation and implementation. Rich people don't pay less in taxes because they're cheating. They pay less because they understand the tax code and structure their lives accordingly. The same strategies are available to everyone, but most people never learn about them. The tax code is public information. The strategies are legal. The only difference is knowledge and implementation. Stop complaining about unfair taxes and start using the system the way it was designed, because now you understand the rules too.